over time permitting, we will try to get as many questions answered as possible. Please use the raise a hand feature if you have any questions. If you experience any technical issues when it is your turn to speak, please communicate this in the chat and we will address that. If you would like to download the corporate presentation, you can access these in your virtual briefcase during and after the presentation. You can also explore more information using the tabs on the bottom right of your screen. Before I hand it over to presenter, I will just make a quick introduction about Gabriel Linen. Gabriel was founded in 1954 as Stark Diaper Services and later grew to meet the demands of healthcare and hospitality industry. To better reflect the company's evolving role and to honor its founder, the name was changed to Gabriel Linen Systems in 1984. Today, the company is the largest provider of laundry services in Canada and one of the largest in the UK and Europe, meeting the needs of healthcare, hospitality, and other commercial sectors. We're delighted to have the management with us. We have with us Christy, who is the Chief Financial Officer. She had joined Gabriel since 2001 and was the Chief Financial Officer from January 2004. Through which they had completed the initial public offering and the debt financing. After stepping away from Gabriel for a year, she joined again and served as Director of Financial Planning, during which time she has played a key role in all aspects of growth and financing initiatives. She had joined Gabriel from PricewaterhouseCoopers and holds a Bachelor's of Commerce degree from University of Alberta. We also have with us Linda, who is the Director, President, and Chief Executive Officer at Gabriel Linen. Linda had joined Gabriel in 1998 as Chief Financial Officer and became President and Chief Executive Officer in January 2000. Prior to joining Gabriel, she was Chief Financial Officer of Canadian Innovatech Inc., a biochemical product processor. She has prior experience in Overweta Food Group as well, where she held a number of financial positions. She has an MBA from University of Western Ontario. Thank you, Linda and Christy, both for joining us. We really appreciate it that you've taken out your time to share with us your story and to be accessible to our investor community. With that, I will hand it over to you for the presentation. Thank you and welcome.
Great. Well, thank you so much, Naman. Just to get started here, we'll give you a brief overview of the company. On to slide 3. We are the largest healthcare and hospitality laundry and linen processor in Canada. And with our acquisition of Fishers, we're now one of the largest in the UK. We've been in business for over 65 years, started in Edmonton as a family business and was subsequently sold to 2 different PE firms in the 80s and 90s and owned by them until the company went public in 2005. Pre-COVID, approximately 55% of our business was healthcare based, servicing acute care hospitals and long-term care facilities, and 45% serviced the hospitality industry, so large hotels across Canada and the UK. Our healthcare business is secured by 5 to 10-year contracts, and our hospitality business secured by 3 to 5-year contracts. If we look at slide 4 now, what you can see here is we operate 15 facilities and 2 distribution centers, 9 facilities and 2 distribution centers in Canada. And with the acquisition of Fishers at the end of 2017, we operate 6 facilities in the UK, in Scotland and the northeast of England. And really, it's this network of strategically positioned modern facilities that enables us to provide the critical services required by both our healthcare and hospitality customers. Over the last 5+ years, we've invested over $100 million in Canada in the latest equipment and technologies, enabling us to provide the highest levels of service and quality to all of our customers, as well as to be the low-cost producer in the industry. On slide 5, we'll show you the we'll demonstrate to you the continued strength of our business model. We've continued to grow our market share in the laundry and linen processing sector over this time. When we went public in 2005, we had 4 plants in 3 provinces in Canada. Today, we have 15 plants in Canada and the UK, Revenue has more than doubled since 2009, growing from 87 million to 252 million in 2019. And really, this growth has come from all areas: organic growth from our existing customers, greenfield, new builds, increasing market share, as well as acquisitions. Our vertically integrated business model provides complete supply chain solutions to our customers at reduced operating and capital costs versus providing the services internally. And this trend has continued over the last 20 years, where more hospitals and hotels continue to outsource this service. We're also able to take advantage of scale by purchasing large quantities of linen at highly competitive prices, given the quantities that we buy, and can spread our fixed operating costs over substantially larger volumes of processed linens. We have a deep industry experience and a reputation that spans over 65 years and create value through this operating expertise. We've conservatively managed our balance sheet with significant credit available for initiatives, including CapEx, like the projects we talked about just a second ago, as well as acquisitions, as well as to weather unusual circumstances such as those that we're currently facing with COVID. We continue to have proven strategies for growth and have successfully integrated 7 acquisitions, built 5 new state-of-the-art plants, and executed on many plant expansions in the last decade. Slide 6. This represents a consolidated financial overview of K-Bro. In terms of our top line, our revenue comes from 2 key areas: the healthcare and the hospitality sectors. Our revenue for 2019 was 252.4 million, with approximately 45% of our revenue coming from hospitality and 55% from healthcare. Obviously, in 2020, as the result of the impact of COVID, revenue decreased to just under 200 million, or a 20% decrease. And as the result of the significant impact to the hospitality industry, our mix of revenue between healthcare and hospitality shifted to approximately 77% healthcare and 23% hospitality. Previous to this, we'd seen nice annual revenue growth year over year. Our adjusted EBITDA before the adoption of IFRS 16 for 2019 was 38.7 million, with net earnings of 10.9 million and earnings per share of $1.03. Again, due to COVID, we saw a decrease in adjusted EBITDA before the adoption of IFRS in 2020 to 35 million. On slide 8, the base of our business with healthcare and hospitality. Both of these revenue streams are secured by long-term contracts. The healthcare business is non-cyclical and an essential service backed by 5 to 10-year contracts, and our hospitality contracts are generally 3 to 5 years in length. As you can see by the chart on the right, roughly 40% of our revenue is from contracts that extend into 2024 and beyond. In terms of the business model, slide 9 really speaks to the competitive landscape and trends that we've experienced over the past several decades. In addition to K-Bro, the competitive landscape includes independent, privately owned facilities, generally owner-operators with 1 or 2 facilities, the mom and pop story. Public and private sector laundries that are off-site and process for a number of member hospitals or their own hotels. And public and private sector on-premise laundries that are located either on-site at the hospital or on-site at the hotel. Certainly what we've seen over the past decade is an ongoing shift to outsourcing laundry and linen services. And really this has been driven by several factors, including linen not being considered a core to a hospital's mission or patient care, and a hospital's desire to provide, and a hotel's desire to provide an excellent guest experience. Laundries and laundry infrastructure is very capital intensive. Significant capital in operating the savings can be achieved through outsourcing, as large laundry operators are able to achieve economies of scale. And a real desire by both hotels and hospitals to repurpose valuable square footage at both hospitals and hotels that can then be used for revenue generating purposes. Our business is fairly specialized with experienced operators and we use technology to manage inventory and report on linen usage, leading to better management of the entire laundry and linen supply chain. So these are some of the factors that have resulted in a continued ongoing shift to outsourcing of this service that is critical to both the healthcare and hospitality segment. On slide 9, you can see that both the Canadian and UK markets are large with significant organic and acquisition growth opportunities in both the healthcare and hospitality space. In Canada, we estimate that the Canadian market is around $600 million. We have approximately 30% of the market. Other private sector competitors have around 40% of the market and remains quite fragmented. And about 30% remains insourced, which represents opportunities for further growth. In the UK, we estimate the market to be about £750 million, with Gabriel/Fishers having approximately a 5% market share. The remaining private sector competitors have approximately 64%, and approximately 31% is insourced, and there are opportunities in both healthcare and hospitality to gain insourced market share. If we look at market share by region, we'll start with Canada. Here you can see that in each of our markets throughout Canada, you can see our market share relative in the dark blue relative to the in-house market share in the baby blue, and the rest would be other private sector laundries. You can see we have a strong position relative to our private sector competitors. However, there remain growth opportunities in all of our markets. In addition to that, you can see there are certain provinces that continue to process their linen in-house. And as equipment ages, we would expect further outsourcing opportunities to be available. If we look now onto the UK, onto slide 11, this speaks to the market share for Fishers in Scotland and the northeast of England. This is the markets in the UK that we service in Newcastle. In the market where Fishers was founded and is the strongest, we have about a 37% market share, while other private sector participants make up approximately 30%. Approximately 30% of the market share remains insourced, and virtually all of the healthcare in Scotland remains in-house. And really, we do see a real growth opportunity similar to Canada, where 15 years ago, much of the Canadian healthcare laundry sector was insourced, which of course doesn't remain true anymore. On slide 12, you'll note our client base consists of large provincial health authorities such as Alberta Health Services, as well as individually managed major hotels such as Sick Kids or St. Mike's in Toronto. Our healthcare customers also include large buying groups. For example, in BC, Vancouver Coastal Health acts as a buying agent for themselves, as well as Fraser Health, Provincial Health, and Providence in that market. We're also very privileged to include national hoteliers such as the Fairmont, the Four Seasons, Hyatt, Hilton, Delta, Marriott, the Starwood Group. All of these are among our clients. In the UK, where approximately 90% of our business is hospitality, we service large hotel chains such as the Travelodge, Jury's Inn, Hilton, and the Marriott. On to slide 13. What you'll see here is that we continue to excel at renewing our existing contracts with our valued customers. We have very high retention rates up in the 90 percentile range and have been servicing some of our major customers for many decades. And really, the long-term nature of our contracts helps us establish strong relationships and offer additional services to our customers, which really does further strengthen our position. On to slide 14. We've remained very focused on growth in regions where we have an existing competitive advantage or can develop a new one. Over the past decades, particularly the last decade, we've invested more than $250 million in our business in terms of new plants and equipment, with a significant amount of this reinvestment happening in the last 3 years. So, for example, in 2017, we opened a new 90,000 square foot state-of-the-art facility in Toronto for a total investment of $37 million, including the purchase of new efficiency-enhancing equipment and leasehold costs. Our new plant here replaced an old, inefficient operation that was running over capacity. Really, what this investment gives us is the platform for further growth in the largest market in Canada, and has enabled us to significantly reduce our labor cost in the range of 25%. In BC, as the result of several major healthcare contract renewals and new healthcare contract wins, we moved forward to build a new state-of-the-art facility in Vancouver, which opened in 2018. This new facility expands current capacity, as well as enables us to consolidate all of our healthcare business into one plant. We upgraded and replaced equipment at our existing hospitality plant in the Vancouver market, also resulting in significant operating efficiencies. So this investment in our 2 Vancouver facilities was approximately $55 million. So if we look at our capacity overall across our network of plants, what you'll see is that we have excess capacity in all of our plants. With our large healthcare operations in Vancouver, Edmonton, Calgary, Regina, and Toronto, we're operating a single shift. This allows us to expand our shift patterns into a shift and a half or 2 10-hour shifts, ultimately allowing us to add significant incremental volume with having to make large investments in additional infrastructure. On to Scotland, you can see pretty much the same picture here. Again, this is predominantly hospitality business, with 10% of our work here being clean room business. But in each of our plants, you can see that we have additional opportunity to add incremental profitable volume and leverage that existing infrastructure. In terms of how we've grown the business, on slide 17, what you'll see is a number of our recent acquisitions. They have played a meaningful part of our growth strategy over the last 15 years, and I expect this to be the case going forward. We entered the Victoria, Montreal, and Quebec City market through acquisition, and have completed 2 acquisitions in the last several years. At the end of 2017, we acquired Fishers in the UK for a net purchase price of $60 million Canadian. And as I mentioned before, Fishers was the largest player in Scotland and the northeast of England, and really does give Gabriel a strong foothold in the UK market. At the end of 2018, we acquired Calgary-based Linatec for just under $5 million and have consolidated that volume into our existing Calgary plant. We also acquired a smaller player in D-Side, called D-Side in Aberdeen in 2019. It was a hospitality plant, and we consolidated those contracts and those customers into our existing infrastructure in Scotland. In terms of growing the business going forward, our strategy will remain focused on extending our core services to new regions and introduce new related services to both our existing and new customers. We've been successful in this strategy and have entered several new Canadian markets over the past decade. We also introduced sterilization services to the Vancouver market from our new facility, whereby we now sterilize all of the operating room linen that we provide to them, which historically would have been done on site at the hospital. So now in 2 markets, in the Toronto market and the Vancouver market, we provide sterile linen packs to our customers, whereby that sterilization function historically would have been done on site. Overall, we do believe that additional opportunities will be made available as the result of, if we look today, as the result of COVID. We've seen a number of health systems convert to reusable products from disposable, and we expect there to be continuing opportunities of this nature going forward. And on the hospitality side of the business, we obviously we have seen depressed volumes as the result of COVID, but believe that going forward, this will create other acquisition opportunities of other players once some of their business has resumed to normal levels. As we discussed, we've reached the end of an aggressive strategic CapEx spending program to build new facilities and upgrade our facilities that allows us to be the most cost-effective processor in our industry and gives us the ability to really add millions of dollars of new business through our network of highly efficient plants. We'll continue to focus our growth as well through acquisitions, and we'll either consolidate the volume into our existing facilities or operate them independently, depending on the geography in which that acquisition is and depending on the assets that we acquire. So if we look to 2021, what I would say the key focuses for us this year will be to prepare and respond, or prepare to respond to the province-wide RFP that was issued by AHS. We did respond, of course, and that encompasses our existing Edmonton and Calgary volumes, as well as the volumes for various rural locations throughout the province. This represents a significant opportunity for us, and we will respond to AHS as they move forward with their process. In terms of timelines, we do expect that there will be communication in Q2 as outlined in their RFP documentation. We also believe that COVID will continue to present as well uncertainties for us. So we will focus the remainder of our year on managing the impact of the pandemic on our operations and quickly scaling up. As we saw last summer, we saw a significant resurgence at the end of Q2 and Q3. So we will remain very focused on scaling up and scaling down, increasing head count as volumes dictate. And just as a final reminder, 4 of our plants are primarily hospitality, 3 which are our smallest plants in Canada, and of course the UK is predominantly hospitality. So as we progress throughout 2021, we'll be focused on continuing to manage the cost structure and profitability within the COVID environment and prepare for a reopening of the economy and working diligently to bring our plants back in line in the most cost-effective manner. In terms of a little bit of back on the management team, as was mentioned in the introduction, I've been with the company for over 20 years now, and Christy, our CFO, has been with the company for close to 20 years. Sean Curtis, our COO, has been with the company for over 35 years and knows all aspects of the business, including not just plant operations and the development of new plants, but has been very instrumental in business development and in developing future talent. In terms of other members of our senior management team, I think one of the things that I'm most proud of is that all of our general managers have grown up in the business, have developed their expertise throughout several decades with the company. Most of our GMs have been with the company anywhere from 20 to 30 years. And as the result of that, it's my belief that we have the best operators in the business. I'll just take a few minutes to show you what a modern healthcare facility or modern healthcare laundry operation looks like and how the business model and the process works. These are pictures from our Edmonton plant, which has become the blueprint for all of our new builds. In any of our new builds, whether it's Regina, Toronto, and Vancouver, we are achieving operating efficiencies from using the latest technology, including a 30% reduction in water, a 20% reduction in the consumption of natural gas, and generally up to a 30% productivity gain just through more automation, better plant design, improvements in technology. And consequently, that's why we made the strategic decision several years ago to upgrade all of our large healthcare plants in Canada. So just to step back and provide you with a bit of an overview of the business, it really is a simple and easy business to understand from an investor's point of view. But as you can see from these pictures, it's highly specialized, automated, and has significant barriers to entry given the CapEx that's required. And really, this does put us in a very strong market position. So at the beginning of the process, you can see we purchase the linen and manage it on behalf of our healthcare customers. We collect the soiled linen from our customers 365 days a year. All of our plants follow Health Canada guidelines and regulations, and we achieve the highest standards of clean linen, adhering to both HLAC and TRSA's hygienically clean standards, which are strict processing requirements that create a barrier to entry for small processors in the healthcare space. The first step in the process is that, just like you do at home, is to sort the linen by classification. You can see on the third bubble, there's hoppers there. We sort by classification to wash it most efficiently and effectively. Once it's sorted, the bags drop into the tunnel washer, which is on the right-hand side of the screen where it says washing. The tunnel washers are about 75 feet in length, and they're highly automated and controlled. On to the next step in the process. After the washing and drying is done, we'll fold and iron the linen and then repackage it for distribution back based on set quotas by unit or by nursing unit or by the demands of the hotel, and send it back to our customer 365 days a week. 365 days a year. Some of the specialty value add services that we provide are our Gabriel operating room linen. This competes with the disposable product. And what you can see there is our linen is light tested on a table to ensure its integrity. We measure each number of washes, and after a certain number of washes, it's taken out of circulation. And again, this is a higher margin business that competes with the disposable products on the market. So for example, just for some context, we would provide an open heart surgery pack. And in these packs, it contains very specific things from surgical gowns to drapes to towels, all based on a predetermined quantity. And these packs may differ from hospital to hospital. On slide 24, what really differentiates Gabriel from our competitors is our focus on providing value-added services to our customers, not just the operating room linen, but really in terms of managing the whole linen supply chain and the distribution function. We're capable of delivering extensive reporting by unit or by ward, providing linen usage and costs to each of our clients. We work very closely with them to help our customers reduce linen consumption through the use of best practices of our product. And it's really these types of activities that build tremendous loyalty from our customers as they see us working very closely with them to help achieve their objectives. On the hospitality side of the business, we also focus on being a complete laundry and linen solution. For certain customers, we deliver the linen directly to the floors. And with our acquisition of Fishers, we expect to introduce RFID technology, which they use at Fishers, to better understand linen usage and linen life. I'll now turn it over to Christy, who will provide you a financial overview starting on slide 25.
On the left-hand side of this slide, just highlighting the exception of 2020, which was impacted significantly by COVID, just highlighting our steady increase in annual revenue. In 2019, we reported consolidated revenue of approximately $250 million, which compares to about $136 million in 2014 and represents an 85% increase on a consolidated basis since 2014. And this growth came mainly through new contract wins, acquisitions, and organic growth in existing markets, as well as
Sorry, Christy. Sorry to your voice is a little breaking up. If you could be closer to the mic, that would be great.
Oh, sure. Sorry, I'll maybe just start again here. So
yeah, we can hear you now. Thanks.
That's better. Okay. So just on the left-hand side, with the exception of 2020, which was impacted significantly by COVID, just highlighting our steady increase in annual revenues. In 2019, we reported consolidated revenue of about $250 million, which compares to about 136 in 2014, and it represents about an 85% increase on a consolidated basis. Now, this growth came mainly through new contract wins, acquisitions, and organic growth in our existing markets, as well as the acquisition of Fishers in 2017. Now, if you look at 2020, you'll see revenue has decreased, and it's decreased about 20% over that of 2019. And again, as Linda mentioned earlier, this is really due to the significant impact of COVID-19 on our hospitality segment. Overall, for the year, the hospitality revenue was down about 60% compared to 2019, just as obviously as a result of the various government restrictions that were put in place throughout the year. This was somewhat offset by very strong healthcare revenues, which increased about 10% on a year-over-year basis due to increased demand from the pandemic. On the right-hand side of the slide, for fiscal 2020, adjusted EBITDA before the adoption of IFRS 16 was about $35 million. And again, this represents a decrease of approximately 10% on a year-over-year basis from fiscal 2019. And again, was due to the pandemic and the significant impact to our hospitality industry. Now, previous to this, other than 2017, where we saw significant transition costs that were associated with some of our new plant builds, we had seen a very steady growth in EBITDA. Just moving on to slide 26. So what this slide provides is just a snapshot of our revenue and our EBITDA segmentation between our Canadian and our UK operations, as well as our healthcare and hospitality sectors. And I'll just make maybe one note that these figures are based on our 2019 revenue and adjusted EBITDA, just as that better reflects the long-term nature of our existing segmentation before the impact of COVID-19. So really what you see on this slide from a revenue perspective, Canada represented approximately 75% of our revenue, and Fishers made up the balance with a consistent mix of EBITDA of a 75-25 split. So moving on to slide 27, we'll now just take a quick look at our 2020 results. As I mentioned earlier, revenue decreased to 196 million, just shy of 200, which is a 22% decrease compared to 2019, again, primarily related to the COVID-19 pandemic. Initially, 2020 actually saw very strong revenues. We increased 5.2% compared to 2019 for the first 2 months of 2020. However, beginning in March, when the World Health Organization declared COVID-19 a pandemic, we saw an immediate effect on our hospitality customers, and they experienced significantly reduced occupancy and closures, resulting in a significant impact to our revenue. On a consolidated basis, adjusted EBITDA without the adoption of IFRS 16 and the impairment of assets in 2020 was about 35 million, which compares to just shy of 39 million in 2019. And this included about 8.3 million in CEWS subsidies that we received in 2020 in the Canadian division. Our consolidated adjusted margin, EBITDA margin, was 17.8% for 2020 compared to 15.3% in 2019. Our dividends remained consistent year over year, and we saw a decrease in debt from 2019 of 62.5 million to our 2020 closing number of 40.7 million. At the end of 2020, we had relatively low leverage levels with a funded debt to EBITDA ratio of just over 1 time. So moving on to the next slide. As I noted previously, COVID has had a very significant impact to our hospitality business. This table really summarizes the impact month by month and quarter over quarter, the impact to each segment of our business that COVID has had. As I mentioned earlier, we began 2020 in a position of strength with consolidated adjusted EBITDA without the adoption of IFRS 16 for the first 2 months, increasing 1.8 million compared to the same period of 2019. And again, as I mentioned earlier, revenues were up 5.6% for the same period. Then the COVID was declared a pandemic, and in order to address the significant adverse effects, we had to quickly react to implement plans to mitigate these effects, which included consolidating our operations, reducing headcount, and accessing available government assistance programs. As we entered Q2, you'll note on the table that hospitality revenues were down about 90% on a year-over-year basis. This improved in Q3 when government restrictions were temporarily lifted to some extent. But as Q4 progressed, we saw an increase once again and a decline year over year. So overall for 2020, we saw a 60% reduction in our hospitality revenue. On the healthcare side, in April, when the most significant lockdown occurred, we actually saw a decrease in our healthcare revenues of about 8%. But as the year progressed, due to product conversions and usage change practices, we saw increases ranging from 10 to 25% month over month, with an annual year over year increase of 9% on the healthcare side. So, and into 2021, we've seen similar volume levels to that we saw in Q4 for both January and February. Now, despite all this impact to our revenue streams, we've continued to generate free cash flow, and we have sufficient liquidity to weather through the storm with about 58 million unused capacity. Moving on to slide 30, our trailing 12-month payout ratio is hovering around the 40% mark. And our ability to maintain and grow our dividends is really made possible through increasing market share through new customer contracts, extending core services to new markets through greenfield activity and targeted acquisitions, and introducing new related services. We continue to evaluate our payout ratio and our dividend policy in the context of COVID-19 on a regular basis. And then just looking at slide 31, you'll note that Gabriel has performed well over the past 10 years relative to the TSX composite. And you'll just note that on the graph on the screen. So I'll now just quickly turn things back to Linda for a quick closing address.
Thank you, Christy. So I think I'll just end off by saying that we are highly confident in the strength of our business model. I think what we have seen in COVID is that we have fared relatively well, largely because a very big piece of our business, 70% of our Canadian business in normal times, and with normal hospitality volumes, approximately 55% of our business is secured by long-term healthcare contracts. We have a network of state-of-the-art processing facilities in all of our major healthcare markets that will enable us to continue to be the low-cost producer, as well as to add millions of dollars of additional revenue to profitably grow and increase our margins. We have a deep industry experience and are a leader in the country, and we have a very deep and experienced management team. The nature of our business, whereby our revenue is secured by multi-year contracts for large portions of our business, healthcare much longer term, but contracts for hospitality volumes as well, all speak to the strength of the business model. And we have a very conservative financial position and credit profile with debt to EBITDA of about 1 time. And finally, we have continued opportunities for growth, both through new greenfield wins, through acquisitions, as well as continued on organic growth through winning market share. So with that, I will open it up if we have time for any questions.
Thank you, Linda. Thank you for your presentation. I appreciate it. I think we're sort of close to at the end of our allotted time, but I think I'll just ask one question on behalf of our clients and investors here. In your presentation, you've mentioned you have some top tier clients for which you have a good relationship. I'm just wondering for how many years you've had that relationship and what sort of retention ratio you have with your clients.
Yeah, so I mean, given the nature that our contracts are typically on the healthcare side 10 years in length, a great example is Alberta Health Services, where we have serviced them for pretty much 30 years now. 30 years in Edmonton, 20 years in Calgary, plus 20 years in Vancouver. We do have decade-long relationships with many of our healthcare clients, as well as some of our many of our hospitality clients. In fact, I would say that our retention rate is in the high 90%. So with that, that comes from being able to provide a great service and a great product over many, many decades. And we're very proud of that and would expect that to continue.
That's great. Thank you once again. That sort of brings up close to our time. I really appreciate it. I think it was an extremely informative presentation. I'm sure investors got a lot out of it. Once again, thank you. I really appreciate Linda and Christy, you guys taking out time to speak with us and with the investor community. I really appreciate it. Thank you. This sort of concludes our presentation. Thank you all for attending. To exit the webinar, you can click the leave button, but we have another upcoming presentation. If you want to attend that, you can sort of stay on the link. Once again, thank you, Linda and Christy. Appreciate it.
Thank you.
Video off.